Blue Owl, BlackRock, Blackstone, Cliffwater, Morgan Stanley.
Yeah.
5 of them have gated on how much withdrawal you can make on a private credit, which obviously is a very, very big red flag, right? Because if people can't withdraw their money, that means there is not enough cash flow for them
Yeah.
to get interest. So if you were to tell me how this is not something that people in MENA region should be worried about.
Excellent question. And the one I actually just recently posted about on LinkedIn, we did a white paper on it because we get that question quite a lot from our
Yeah.
institutional investors who invested in a lot of these large managers in the West.
Yeah.
Let's first identify what is it that's actually happening. Why are they
Yes.
gating? They're not gating institutional investors from taking their money out. So private credit, the traditional private credit, which is model we're operating under, is an illiquid investment in an 8-year fund.
Okay.
It has an optionality of extension by another 2 to 3 years depending on the fund. Meaning, if an investor comes and gives us money, they cannot take it out for 8 years. That's just the risk they know, right? For that risk, they're getting 17 to 18% returns, 10% cash, they're on a quarterly distribution. So that's called the illiquidity premium.
Okay.
So you do that in private equity and you do that in private credit.
Yeah.
The challenge is why this is now ballooned, this issue that's been coming up, is that all these giant firms have already raised so much money from institutional allocators, sovereign wealth funds, pensions, endowments, who are comfortable with the illiquidity and getting paid liquidity premium for that. But they get to a point that for them to move the needle from an AUM growth perspective, they started going after retail investors.
Okay.
Retail investors want to get similar private credit returns, but they still want the flexibility of a public equity market or public fixed income, like a bond.
Yeah.
So they created these synthetic vehicles.
Okay.
They're still doing private credit investments, so they're still giving loans for 4 to 5 years to the borrower,
Companies. Okay.
but they created a synthetic liquidity window for retail investors to come in on a quarterly basis into these vehicles.
Okay.
And they also allow them to come out on a quarterly basis.
Okay.
This structure works beautifully when the market's going up.
Yeah.
Meaning sentiment is up, your loans are performing.
Yeah.
In private credit, their loans are still performing, but the sentiment in the market is shaky.
Yeah.
So what happens in shaky sentiment, retail investors start taking money off the table in strategies that they can't take money off the table. These are the vehicles that they have that they can take out money. So all of a sudden, people are saying, let me take money out.
Yeah.
These managers didn't expect that they're going to be getting that many redemptions.
Yeah.
And again, it's a mathematical equation. They were only assuming 2 to 3% maximum of redemptions because they were basing it on historical trends. Historical trends, there was no redemptions because it's a new structure that's been around for maybe 5-6 years. So if that structure is new, there's no precedence for it. Now they're getting, and then it becomes a snowball effect. People start hearing that it's becoming, people from this fund start hearing, Blue Owl was the first one.
Yes, Blue Owl was the first.
So then people in other similar strategies say, wait, I'm not in Blue Owl, but I'm in HPS BlackRock.
Yeah.
Or I'm in this and this. And then so then retail investor starts,
Yeah.
they don't realize that it's not the loans that are not performing, it's the actual, the structure, the liquidity structure that they created is inefficient for retail investors.
So did this issue start because of the war? No, right? Like Blue Owl was already.
No, it was already happening. I think I don't know the rationale of why it started happening, but people were getting a bit edgy from markets, from particularly, I think, the new tariff kind of boogie word that kept on changing and coming out of the US has caused a lot of people to feel uncertain as to, are we going in an upward trajectory from an economy, or are we going down? So that's my guess. I don't know really why the sudden shift to people trying to redeem.
Blue Owl, just all of a sudden, it just happened and everything followed.
But then that's what happened, the snowball effect, the trickle-down effect to all the other ones that have similar strategies. And look, I've worked with large asset managers, and most of them, the main money-making machine is the institutional investors, the sovereigns, pensions, endowments. But those investors, typically when they come in with size, they negotiate fees. So rarely do they pay 1.5% or 2%, or depending. They get negotiated fees. But retail investors pay 2%, right? So if you get a good distribution agreement and you get several billion of just retail money in a good period, it's amazing. It's the challenge is, how do you keep them when they expect that they
Investing.
can get out whenever they want. But guess what? That's what there's a liquidity premium or illiquidity premium for private credit or private equity. Same thing you've heard during times of distress during hedge funds.
Yes.
Right? Hedge funds are great when things are going well. When things are not going well, they have to put up gates because then, unlike private credit, they're at least investing in liquid
Public
markets.
true.
So they need to actually just need time to unwind positions.
Yeah.
In private credit, these are loans you've given them.
Yeah.
How are you going to pull it back?
Yeah.
Like you gave a $50, $100, $200 million loan to a company. And now you're getting redemptions.
Yeah.
How this loan is for 4 years. You can't call it back, right?
Yeah.
You can't say, hey, my investors need their money. So it becomes a challenge when it's still playing out now. It's just, I think we're in the beginning of it.
So you think it's going to get worse?
I think for these structures, they're creating a retail share class for an illiquid strategy.
Yes.
Is not, I don't agree. I mean, my humble 2 cents on it, I don't agree with it. Is that just in great times it works, but when challenging times and people, you cannot rationalize with retail investors, is that it just takes one blue owl for all the others who have similar investments to say, get me out of this. I don't want to wait to find out that there's a real problem in the underlying loans, right? If it's just even a loan structure, I want to get out. And that's why for us, again, we're still at the infancy stage in private credit here versus the West.
Yeah.
All we deal with is institutional investors.
Yeah.
We don't talk to retail investors. We don't think it's appropriate for retail investors because retail investors, you rarely do they have a proper asset allocation model to begin with, right? And so you need an institutional investor who has a dedicated segment to private credit. And don't give all your money to us. Give it to us and some other competitors. So you balance. You balance it, right? You balance your risk. But retail investors sometimes just go with the fad, right?
I think they also need to learn what alternative investments are.
Correct.
I think it's new for them.